Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. And of course, we've got the state election in New South Wales this weekend. Former New South Wales Premier, the Honourable Bob Carr, on how a China-US rapprochement could be a future threat to Australian LNG exports, and of course on whether his man Michael Daly can pip Gladys Berejiklian to the post as the new Premier this weekend. Rob Millner delivers another great half for Soul Pattinson shareholders thanks to New Hope Coal and Brickworks fired up. So why was the market disappointed midday? My interview with Soul Pat's chair on why he's sticking with coal, doubling down in the US and sees big opportunity in Aussie financial services. And Janus Henderson, a Global Equities Investment Director, Jane Shoemake, briefs Chief Business Reporter Leo Shanahan on how the change in Fed thinking could be good news for dividends. Now, a recut US-China trade deal, when it comes, could actually spell bad news for Australian gas companies. That's according to new intel from the Australia-China Relations Institute. China is looking to increase its LNG imports fourfold over the next 20 years, we hear. Donald Trump will likely be pushing for the US to be preferred partner in any new trade deal, bumping out Australia on new export contracts. The Institute's director, former New South Wales Premier Bob Carr, says that while current long-term gas export contracts, which make up 85% of our LNG exports, are locked in, the future relationship between China and local gas players may be more under threat. Well, the earliest expiry of Australia-China gas long-term contracts is 2031. Well, for more on this and what to expect ahead of this week's weekend's New South Wales election, I spoke with former New South Wales Labor Premier and Director for the Australia-China Relations Institute, Bob Carr. Bob Carr, thank you for joining me. Can we start with Australia-China relations? How do you see them now under the Morrison government?
Yeah, well, on one level, they're back to normal. The Prime Minister says the relationship with China is positive. And we've got ministerial visits taking place. We went through a year and a half when that didn't happen. On another level, though, you've got to say, probably mainly because of the Huawei decision, that they've continued to deteriorate.
Do you think it was the right decision looking at national intelligence and advice and the strategy and what we were hearing from departments?
Because I don't have access to that advice any more than you do, I'm neutral. But I focus on the way the decision was announced. Was it really necessary to say that our Prime Minister, then Prime Minister Malcolm Turnbull, had phoned President Donald Trump to report what Cabinet had done on Huawei? It looked like we were craven, and there's only one way you could have read that in China, and that was that Australia made its decision on Huawei not out of local concerns about security, but to please the US.
Even though we're a Five Eyes member?
Yes, and then, well, you see, Britain, which is in Five Eyes, we know has got strong MI6 advice that Huawei supplying equipment, having a non-core role, is perfectly manageable. And then we allowed it to get out through a leak to journalists sympathetic to ASIO and the federal government that the heads of our security agencies had got together with their counterparts in the Five Eyes and had a dinner over Canadian vintages and lobster to sort of celebrate the conspiracy, what appeared to be a conspiracy against Huawei. And I just think if you had to make the decision on Huawei, why would you do it to extract maximum loss of face from China's preeminent telco company? I just think there's an ineptitude and a naivety about the way we do these things that is going to disadvantage us.
More broadly, Bob, what do you think the trade tensions between China and the US will deliver for our relationship with China?
It's a fascinating process. There's no doubt that President Trump is attracted to the idea of a big deal, a big overarching deal. And he sees the problem, in contrast to the way it's viewed by his advisors, as being reducing the trade deficit. So the deal he wants to announce at Mar-a-Lago is a brilliant piece of Trumpian diplomacy, is the Chinese guaranteeing to buy more American exports.
America first?
America first, a one-way view of a trade deficit, and that's relatively easy for the Chinese to give him that. That handles what Trump has defined as the problem of the deficit. It probably relegates as less important the so-called structural issues, protection for intellectual property, although I think the Chinese will make big concessions there, and some other things. But Trump's attracted to that, and Australia's got to be very, very careful about that.
Why American exports? Is it because of our competition for the China market? Could it
Absolutely.
come down to that?
Yeah.
In what way?
Yeah. Well, soybeans is not something we're into, so that won't hurt us. If the Chinese say, no, we'll go back to buying huge quantities of American soybeans, that's going to be a blow to Brazil, which is the other big exporter. Liquid natural gas. Most of our exports are protected through long-term contracts. But we have got one challenge here. China's contemplating over the next 20 years a fourfold increase in its purchase of LNG. And it'd be easy to say that that's going to come disproportionately from the United States. And Australia could lose that share of the growth in China's purchase.
Well, that's very interesting because at the moment, of course, Australia's obsessed with our own import terminals. We're building to take Australian gas from the west round to the east coast. But what you're saying is we could be seeing a real build-up of new LNG import terminals in China. And if the US-China trade deal went that way, it could actually really threaten our very big LNG export market going forward, you know, down the track.
Yes, we're just releasing today our analysis of LNG, what America can supply and the extent to which we're going to be hurt by that. And the real focus has got to be on the future growth, with China establishing, I think it's 20 new import facilities and planning to increase fourfold its purchase. It'd be very easy for Xi to say to Trump, we'll get it all from you, and lock us out. I mean, that's why Australia's got to be a bit careful about being carried along by American enthusiasms on China. It's all right for us to get worked up and follow the American line on Huawei, but it's always possible for an American president, Trump or Kamala Harris or Elizabeth Warren, someone in the future, to suddenly take us by surprise and to go round the backs of all America's loyal allies and cut a big deal that puts America first and locks us out.
Well, can I bring us back to Australia and the immigration cap that the Prime Minister announced this week of 160,000? Doesn't seem to be much of a cap to me, given that the actual number at the moment is 162,000. But a while ago now, you were famous for saying that Sydney is full. What do you think of the current immigration policy?
Yeah, well, I'm up till now, I've been a minority of one among the political class, saying there are economic and environmental stroke planning arguments for us going for lower rather than higher immigration. And it's been very interesting for me to watch politicians on both sides gravitate to the Carr position, which was once so lonely. I think the federal government's scrambling to say something they think that will assure the public of Sydney, Brisbane, Melbourne about the pressures of growth. They have pushed it under pressure from the business lobby. They have been pretty bold. We have lifted it. We're running the highest immigration rate of any developed country in proportion to our population. But I think they're pretty unconvincing, not only about this cap, but about holding out the promise of seeing the migrants go to rural or regional areas. That just doesn't happen. That just doesn't happen. The pulling power of the big cities, where you've got existing communities speaking the language, coming from the culture of new migrant communities, is just too great. It outweighs incentives and conditions.
To what extent do you think Scott Morrison's immigration cap coming in as it is just ahead of this weekend is deliberately playing into the state election?
Probably, yeah, probably designed to help there, where I note that Gladys Berejiklian has been forced to say she favours a halving of immigration. But I think looking after the interests of the Prime Minister and the federal poll coming hot on the heels of the New South Wales one.
As a former Labor Premier, you'll no doubt be somewhere supporting Michael Daly this weekend. What do you think of Premier Gladys Berejiklian and her record? I think on the economic front, it's pretty widely being acknowledged that she's got has had a sound record, and particularly on her infrastructure build, some would say a catch-up.
Yeah, well, I take a hit on that front. There hasn't been a new project, transport project, tollway, for example, or rail or light rail, that has opened in 8 years of this government.
Well, ironically, it will open. A couple will open just after this poll.
Yeah, but look, I live in an area where we've seen this disastrous light rail. It shouldn't have been built. There's a perfectly adequate bus service. Perfectly adequate. We all wanted it in the eastern suburbs, and any money from privatisation proceeds going to light rail should have gone in Sydney's Greater West to link new communities to the existing heavy rail network. So it's been a disaster, and it could end up having to attract $600 million in compensation payments to the contractor.
But light rail aside, I mean, there has been some big infrastructure building going on.
Yeah, well, I'm fearful of this plan she's got for $8 billion going to the North Side Tunnel to service the Northern Beaches local government area with a population of 300,000, when that money spent on public transport in Sydney's Greater West, where there's a population of 3 million, would have come up in any cost-benefit analysis. So I think I've never seen squandering, in this case, the proceeds of privatisation. They've had privatisation of all of the electricity assets and all of the ports. For goodness sake, Ticky, you'd be saying to them, there ought to be some infrastructure, and there ought to be some that's opened within 8 years.
So when it comes to recent polls, I think the two parties are pretty neck and neck. Bob, I wonder how you see the impact of that terrible event this last week in Christchurch, and indeed how that might now be playing into the campaign, particularly given John Daly's willingness to, team up with the Shooters Party, and as he said, I quote, "We'll support anyone that people put up." Well,
any political leader is going to say, we will deal with a hung parliament as we find it.
But this is Labor in bed with the Shooters after Christchurch.
No, there's no. I mean, a coalition government would be looking at deals with small parties and independents. If that's the hung parliament you get, it's up to the voters whether they do that. But when it comes to gun laws, there's not the remotest, faintest possibility that a Labor government would say we're going to peel back the gun laws that we arrived at. Premier Carr, supporting Prime Minister John Howard, arrived at in the wake of Port Arthur. The party wouldn't allow it. The leader, Michael Daly, to his very great credit, has said there is no way I would do that. My experience with the Shooters Party in the Parliament, I dealt with John Tingle in the State Upper House, was that they did not press us to roll back gun laws, but they worked with us on other things. They never sought to blackmail us by asking us to do things. They would have wasted their breath. They would have wasted their breath.
But what about the timing of this for Michael Daly? I mean, there's that, there's the unfortunate comments that he made around immigrants recently, which I think has been sort of taken as dog whistling. And then there was the debate with the Premier last night, which I think on the floor he lost and did not seem to be across you know, Labour's budget on education, on stadiums, on TAFE, key parts of Labour platform.
Yeah, but Gladys Berejiklian, according to reports, I missed the debate, couldn't recall whether she was committed to a toll on the M4 extension or not.
So misses on both sides, you say?
Yeah, which really staggered me. I think, look, the electorate, you're right, the electorate is absorbing all of this publicity within New South Wales and beyond New South Wales. I think when it comes to the awful tragedy in New Zealand, they probably, it's not the terrorist disaster that we've been used to absorbing out of France, for example, and elsewhere. It has with that white rage, neo-Nazi origin, it has its own unique characteristics. And I think people in voting in New South Wales would see that. They'd be depressed by it, but unlikely to shift. It wouldn't be logical, not remotely, to vote one way or the other in New South Wales, depending on an analysis of that.
So what do you think will drive people's vote this weekend, and who do you think will come out the next Premier?
It's too close to call, too close to call. I think a strong movement, apparently, in rural and regional areas against the coalition. People say, as I've said about conditions in Sydney, people say they haven't seen a burst of investment in infrastructure. They've seen nothing with the proceeds of privatisations. And it's there that the government's likely to lose its majority. But Labor needs to win seats in the city with a movement of over 6% in those electorates to give itself a chance of having a majority. Otherwise, it'd be a hung parliament.
Bob Carr, so interesting to get your views. Thank you very much.
Thank you, Ticky. Thank you.
Soul Pattinson Chairman Rob Millner on the company's interim results.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. And results day for that very interesting investment company, Washington Soul Pattinson, today with half-yearly profits leaping almost a quarter to just shy of $180 million. The results were driven by significant gains from its brickworks investment, with its contribution after tax profits up 74%, and also contribution from New Hope, that's coal, which saw a rise of 27% on the back of higher prices, as well as an increase in production out of its Bengala joint venture. An interim dividend of 24 cents a share was declared there. Now, Brickworks itself also reported today. In turn, it has 40% share in Soul Pats, remember, and M&A is on the horizon for Brickworks, which is now actively pursuing deals in the US. Brickworks wants to reduce its reliance on Australia for earnings after feeling the pinch from rising energy costs and a slowdown in construction activity here, with headwinds set to impact its Australian building products division. But the company has lifted its net profit for the 6 months through January, coming in just shy of $115 million. And shareholders will be paid an interim dividend of 19 cents a share, up 5.6% on a year ago. Well, Rob Millner is chairman of both Brickworks and Soul Pattinson, the Millner family having had a connection with both for a long time. Now, as usual, the market had some difficulty absorbing results. When I spoke to Rob earlier this afternoon, the shares were off, but by close, they were back up. Here's the interview, which might explain why. Well, Millner, nice to chat again. What does it feel like to be a top 100 company?
Nice to see you again. Yeah, it's interesting because it was only less than 12 months ago we weren't even in any index, so now we're in the top 100.
It's an extraordinary rise. Now, bizarrely, you've got very strong results this half. The market was off, though, was a bit worried about the results. Why was that?
Well, I think if you go back and look at New Hope, who announced on Tuesday, had a record result. There's a lot of talk in the press about coal boats being held up in China, but New Hope did over $600 million in revenue and only 11.8 million of that was in China.
So do you think the market didn't appreciate that?
No, obviously people didn't read the reports properly. We did do 80 million in the previous half, but because of the prices and what's been happening with those ports for quite some time in China, we re-washed some of the coal and sent that into Korea and also into Taiwan.
So Rob, going forward though, what does that look like? Is China still a major market, or are you looking more and more to open up to ASEAN?
China's as I said, 600 million and we did 12 million. It's a tiny part of our market, but obviously it's an opportunity market, same as what Korea and Taiwan and Japan are. So we're obviously trying to always sell where we get the best price.
And as far as the Chinese are concerned, how is their market going from their end? We look at these ports holding up our exports.
Well, apparently it's $10.50 US. More expensive at the moment using Chinese coal than it would be if they used this imported coal. So it's not doing any good for their country either.
All right, well that was New Hope. Your other big earner was Brickworks. Once again, there are concerns post the Hayne Royal Commission and more generally about the housing market. How did you go?
Now, Brickworks had a record half. Again, a lot of that was to do with industrial property. Obviously the building products was down, and that's explained by what's happened since the Royal Commission. We've virtually got a credit squeeze. The banks have tightened up their lending, and the builders are telling us they're at least 50% down on approvals.
Is that right? Do you think that's going to continue?
Well, you saw someone from the Reserve Bank came out yesterday saying that people should be lending more, so hopefully they might start listening and loosening up, because they're getting money inflows, so they've got to be lending that out to make any money. So.
And looking at your property portfolio, you've revalued several properties, and boy, these cap rates, they're still being compressed, aren't they? It's extraordinary.
I can only talk about industrial land because that's mainly what we're in, but there's still a big shortage of industrial land. We've got people like DHL and these people scrambling to get sites. So there's a good demand for industrial land.
And the next change to the Reserve Bank rate could well be down.
Well, I don't know whether people saw, but UBS put an article out a couple of days ago and they said there could be 2 interest rates cuts before Christmas. So,
yeah. And as far as your property, your development side is going, that is still going very strongly as well, is it?
It looks like it's going to continue. We just announced during the half that Coles is going to build a new age warehouse on one of our sites, and just not a single story warehouse. This is a 5-story, completely automated warehouse.
It's at what, over 60,000 squares?
Yeah, and over $300 million.
Gosh, that will be interesting when it happens. Goodness me. Now, the other area, of course, is overseas and in the US. You've got Glengarry now, which I think is cranking up after minus 28 degrees temperatures.
Lindsay and I were over there about 5 weeks ago, and it was minus 28 in Chicago. It was freezing. But interestingly, though, about a month after we had that business, someone from the Philadelphian government came and approached us and asked what could they do for our business. And I have never, ever had anybody in Australia come to me and say, what can we try and help you with your business?
Why did they do that?
Because they're keen for business. They're open for business. They want to grow the employment, and that's the American culture.
What do you see happening with Glengarry now? What do you want to do with it?
Well, obviously they're probably like we were here 8 or 10 years ago. They probably hadn't developed styles. Europe sort of started this 10 or 15 years ago. Because
it's not like the other traditional brickwork companies, is it, in America?
Yes, it's the 4th largest, but it does a lot of architectural work, and they do use a lot more brick over there than what we use. Stadiums and schools are nearly all fully brick, but it's still a lot of that old red brick, so we think we can, by putting design studios in like we've done here, and bring a few more designs over there and make a point of difference between us and our other competitors, that we can grow that business.
Rob, how long do you think before that will really turn around and become a really firing business?
I'd say 4 or 5 years, because we can't go over there, and we don't want to go over there tomorrow and start throwing our weight around. We've got to learn how they run their business and their culture, and
Long term, you look at companies like BlueScope and indeed Boral, more and more their emphasis is on the United States. Do you see relatively Brickworks investment being more and more weighted to the US?
Well, we're looking around at the moment there. There's quite a bit of rationalisation going on in that industry, so we've got our feelers out at the moment having a look around, and you know, we might be able to add a couple of small little bolt-ons as well going forward.
I must ask you about TPG, of course, because you must be just holding your breath for Rod Sims at the ACCC. What difference would that make? I mean, if you get knocked back...
Well, if we get knocked back, you know, we've got to go back to the drawing board, you know. Obviously, I would have thought we'd go to the courts. But David Teo indicated on Tuesday that he's still very confident, even without Vodafone in the near future, that he can continue to grow the business because we've got infrastructure and fibre.
Yes. And the headwinds from the NBN in terms of margins?
Yes. I think Australia's going to rue that decision in years to come. It's $50 or $60 billion that could have been spent elsewhere. Right,
but you still think, as far as you've got confidence in David Teo being able to drive the business come what may?
And I don't know whether people have seen in our presentation and TPG's presentation that they grew the corporate business quite well in that last half, and we can see that continue to grow as well.
Now, what about your other area, which is, you know, you're more recently interested in, which is financial services and adding financial services? Now, you see a lot of opportunity post the Royal Commission again?
We do. The figures that are floating around now, that there's about just under $3 trillion in the super, and that's in the next couple of decades talked about growing out to 9 or 10 trillion. So there's huge expanse there, and I think good people can manage money for people, for themselves, not other people's money. There's too many people that have ripped other people's money off for the sake of their own.
So what do you think of this wave of popularity with passive investing as opposed to active investing?
Well, you know, you've got to be active as well as passive, I think, in both worlds. They've both got a place, but, you know, we're very focused on long term, and we think growing that financial business in probably 5 or 6 years, it'll be another good string to our bow.
And what do you also make of this rise of ESG? I mean, obviously you're in New Hope now, so you're moving forward with coal. Do you think ESG is going to become more and more significant?
Well, obviously, but people have got to remember there's still 14% of the world haven't got power, and that's particularly in Asia. And this is one of our great strengths in Australia. We used to have the cheapest form of power in the world, and in America we are paying in Australian dollar terms $3.30 a kilojoule for gas. We are paying $11 here. That's staggering. And we're not allowed to drill for gas in New South Wales and Victoria. And we're exporting it all. So
in terms of business inputs, it's very significant, isn't it?
Then you've got higher electricity costs as well.
Yes. What about wage hikes? Because that is the next thing on the agenda, obviously, with a potential Labor government.
Well, obviously, you know, wages have historically been linked to inflation. And this is a trend right around the world, that inflation hasn't it's stuck around that 2 to 3%.
In terms of opportunities to buy, just coming back to my original question, Todd Barlow says it's always difficult deploying capital. People separates the men from the boys or the women from the girls, I guess. But he reckons you're a long way from the bottom of the cycle.
Yeah, things are pretty good, but I think in 8 or 10 or 12 months' time there might be some bargains around.
Rob Millner, always great to talk. Thank you.
Good to talk to you. Thank you.
After the break, will 2019 be a good year for dividends? Our exclusive interview with Janus Henderson's Investment Director of Global Equity Income, Jane Shoemake, next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, the US Fed kept interest rates on hold this week. More of that a little later. But the dramatic change in strategy this year at the US Central Bank seems to be good news for equity investors, making dividend yields more attractive compared to bond yields. That's an important message Janus Henderson's Investment Director for Global Equity Income, Jane Shoemake, is delivering to her clients during her visit to Australia. She sat down with Your Money Chief Business Reporter Leo Shanahan for an exclusive interview to talk about prospects for dividend payouts globally and the viability of our big bank stocks.
Jane Shoemake, thanks so much for joining us.
Pleasure.
Now, I wanted to start off by asking you about the Janus Henderson Global Dividend Index, which of course you helped create, but it says we've seen Australian payouts inched ahead just 0.9% year on year on an underlying basis, the weakest among the world's major developed stock markets. Australian banks account for almost half the country's total dividend, and weak profitability combined with already high payout ratios means it's difficult for them to increase their dividends. Have Australian stocks reached a high watermark in payouts?
I think Australia is already a high-yielding market, so it's quite difficult from this very high level of dividend yield to increase that massively. Payouts are quite high and concentrated in a very small number of companies. You've talked about the banks. I think their payouts are already paying 80% out. Earnings profiles looking forward are quite challenged for the banks. They don't have much earnings growth, therefore we don't expect much dividend growth. So I think payments can be maintained, but I don't see any increases coming through.
Are Australians too reliant on dividend yields then?
I think the fact that you've got such a lot of concentration means it makes sense to look more globally. If you go global, you can access sectors and stocks that you can't access in your domestic market. For example, technology has been a very strongly growing dividend growth culture there, but you can't really access that through your domestic market.
You mentioned the banks. Obviously, Australian banks have had a tumultuous year, the Royal Commission, a regulatory crackdown, facing large fines. What's your view on Australian banks as an investment option?
So in the product that we have here in Australia, it's ex-Australia because we want it to complement domestic holdings. Other products we run on our desk, we do have Australian exposure and we don't currently have any Australian banks. They have derated. They're not quite as expensive as they used to be. They always used to trade on a massive premium. They're now much more in line with some other global banks, but we still don't think they're cheap enough compared to some of the other opportunities we've got around the world.
Now, Australian stock you do like are the miners, especially the big BHP and Rio Tinto. Your view on them?
Yeah, we do have holdings in those on products where we're allowed to hold Australian stocks, so we do have exposure to BHP and Rio. We've seen a massive increase in the dividends that they cut. A lot of these miners cut their dividends in just 2016, so they've come back, started to pay dividends again. They're throwing off a lot of cash, and so we have got holdings and exposure there.
Very Australian question, but who do you prefer, BHP or Rio?
We like both of them.
Like both, very good. Now, I've mentioned the miners and the banks, but that is really the Australian market in a lot of ways. There's a lot of complaining that we are too reliant on the banks and the miners. Is that the case?
In Australia, you have a very similar issue that we have in the UK equity market, actually. You've just got a concentration of very large companies paying out a lot of the income. And we think that gives a concentration issue. When you have an issue such as Telstra, where they suddenly cut a dividend, that makes a big difference to people. So all we're saying is we think it's really important to diversify that income stream, because if you're a pensioner relying on that income to be paid, you don't suddenly want to find that you're not going to get any money from a company. We had the same issue with the banks in the UK after the GFC. Lots of people held those banks for their dividends and they completely disappeared. So it's about just spreading your risk and having some diversification.
Of course, we have a huge debate in the country at the moment around the franking credit imputation and refund policy. Labor has said that if it gets into government, it will abolish that policy. Your thoughts on the policy and whether it should stand?
We had franking credits abolished in the UK in 1997, so we did have something similar, and that went. In terms of what's going to happen in Australia, any change to that franking credits is just going to make international dividend payers more attractive, because at the moment there's a real incentive for people to keep their domestic holdings. Whereas if that changes and the tax credit changes, then it's going to make the international markets more attractive.
From a policy perspective, do you think it's justified? Do you think it should be abolished?
I don't have any view on the actual underlying policy and the politics.
Has it been artificially driving up dividends in Australia?
I don't think it's been artificially inflating them, but it just means that because there's tax credits around them, it's going to incentivise management to make sure they keep paying dividends to people.
And your view on the policy, is it good policy? You think it should be abolished?
Even if that franking credit disappears, Australia at the moment, if dividend levels are maintained, is still going to be a high-yielding market.
More Australians are investing in global stocks than ever before. Globally now, what are the trends and what are the markets that you think will be doing well into the new year?
We just had 17 and 18 were both really strong years for dividend growth. 16 was relatively flat. The index is in US dollars, so there is some changes with regards to foreign exchange, etc. What I think now is for next year, look, we're clearly facing a slowing global economic environment. We have already seen corporate earnings being downgraded this year. So already we've seen downgrades to expectations for profits. So I think this year we're still going to see growth in dividends, but it's going to be at a lower level, more around the long-term average of around 5%.
Now, you mentioned tech. It's interesting, I recently spoke to a CEO of an Australian tech company, I won't name which, who said the dividends are for companies who are out of ideas. It's interesting, though, that you mentioned tech stocks as having, well, a good value proposition for dividends.
The tech sector is quite interesting because there's a lot of stocks that don't pay a dividend, and that's fine if you're still generating huge growth and getting a decent return on that investment. But there are a number of tech companies that have got to a more mature stage. They're still growing, but they are throwing off so much cash that they're paying dividends. So there's a whole raft of tech stocks that are paying 3-4% in dividends. They're also giving cash back to shareholders in specials and, of course, doing buybacks. So for us as income investors, tech is a very interesting sector, provided we pick the right stocks.
Yeah. What about mining? We did briefly mention BHP and Rio, but you do like the area generally.
Well, mining companies, as I said, having cut dividends so dramatically just a couple of years ago, have returned back to paying dividends. And that means that was one of the better performing sectors, again, in terms of dividend growth that we saw over the last year, just as the underlying commodity prices have fed through to better profitability.
We have a situation where interest rates are remaining low. Just today, Jay Powell saying, indicating rates will stay low. Surely that's got to be good for dividend yielding stocks as well, because fixed income isn't going to be going anywhere.
Yeah, monetary policy shifted dramatically, particularly with the Federal Reserve changing the way it's, the expectations around hikes there over the last 3 to 4 months. And obviously, if we don't see cash rates continue to rise, that does make dividends look more attractive on a relative basis.
And your outlook for the global economy, a lot of people concerned about a global recession in Australia, people murmuring that we could be in a recession soon for the first time in 30 years. What is your outlook?
In terms of global economy, we've had a period of synchronised growth. That is clearly coming to an end. So we think there'll still be growth, but it will be very dull and low.
Jane Shoemake, thanks so much for joining us.
Thank you.
Now, the horror attack in Christchurch was felt all around the world, with so many questions about why it happened at all, and in all places, the South Island of New Zealand. Prime Minister Jacinda Ardern's handling of the atrocity has been widely acknowledged as pretty remarkable, but the Christchurch attack is also being talked about as a textbook example of communication during an emergency. Well, Christchurch was, of course, top of mind at this week's International Government Communications Forum in Sharjah. For more, Your Money reporter Leanne Jones joins us live on the ground there. Leanne, tell us a little bit about what's been happening.
Good afternoon to you, Ticky. Look, it's certainly been a big conference over the last 2 days or so. As you say, I'm here at the International Government Communication Forum, and a lot of thought leadership that's taking place here. There's thousands of international delegates that have come from all over the world. There's about 150 countries here, in fact, and a lot of conversation around some of the big issues that are affecting global markets at the moment and how, in particular, governments are dealing with them. At the moment, and you mentioned in the wake of the New Zealand terror attacks, there has been an increasing focus on extremism, the rise of populist movements, terrorism, all fueled by changes in technology and social media. And that is very much a challenge for governments around the world, trying to address fake news and propaganda and really trying to eliminate some of these big issues. Of course, on top of that, I mentioned technology. You have artificial intelligence and robots, which are very much changing the outlook for the future of our jobs. So a lot of big issues that are being discussed here, and that is really what this conference is all about, trying to put the spotlight on some of those big issues. Of course, there has been a big focus on the terror attacks in New Zealand, and as we know, social media companies have come under a huge amount of pressure, calling on them to take more responsibility for the content that they share. A question that's being posed here is, what role does the government play in actually administering these social media companies versus the role of social media companies themselves in dealing with situations like this in the wake of those terror attacks? Now, I actually spoke with the general manager of Arabiya, who is one of the biggest news networks across the region, in fact, and in the wake of the terror attacks, I asked the question, how do they decide what content to deliver to the public? How do they decide what to use and what not to use? Let's take a listen.
So there are ideological aspects of that. There are social aspects of that. But media is not inflaming it. But media probably is not doing enough to help people to understand each other. So individuals cannot fall into the trap, and individuals wouldn't be a product of hatred.
Ticky, outside of all of those big issues, of course, Brexit, it really seems to be dominating the conversation all over the globe at the moment. And it has certainly been a topic of conversation here as well. As we know, it's kind of the crisis that's engulfing British politics at the moment, and it's being described here as a constitutional crisis. I spoke with Sir Craig Oliver, who's the Director of Politics and Communications for the former UK Prime Minister David Cameron. He had a lot of interesting comments to say, actually. He thinks that there will be a deal done. He was a little bit critical of Theresa May and her leadership, but of course he was on the David Cameron side of things. So interesting comments as to the, well, defending him, I guess, in terms of putting us into this mess in the first place. In terms of Australia as well and our relationship, free trade agreements, there's been open questions about how we could benefit. He seemed to be a little less optimistic though.
It wasn't a situation where David Cameron just woke up one morning and said, I tell you what, I'm just going to risk my future and the country's future. The realpolitik of it was that Britain had had this situation coming for a very long time. The Conservative Party, a lot of people in it were driving for it, pushing for it incredibly hard. It meant there was a massive boulder in the road of British politics that until you took it off the road and sorted it, nothing was ever going to get done. In terms of David Cameron actually leaving at the end of the referendum, well, I actually don't think it would have been realistic to have somebody who'd been so strongly in favour of Remain saying, I tell you what, I'm going to deliver Brexit. He wouldn't have believed in it, and actually nobody would have believed that he believed in it. I think it's potential that Australia could benefit from it. The reality, though, for the UK, when you look at it from the other side, is we are just 20 miles off the coast of Europe. There's a massive market of 300 to 400 million people. It's the biggest single trading market in the world, free trade area in the world. And we're cutting that off in the hope that we might be able to do deals with countries that are 12,000 miles away and not nearly as big, unfortunately. So I think that probably there is the opportunity for Australia, but as far as the UK is concerned, cutting yourself off from this market is not the wisest thing that you could do.
Yeah, look, as you can see, they certainly, or Australia could certainly be undermined by their closest partner being the EU. But look, all in all, fantastic conference that's taking place here. Very progressive, the UAE are with respect to technology and the future. So I think there's a lot to be said about what the rest of the world and governments all over the place can learn from what they're doing.
Leanne Jones, great to hear from you, and we're looking forward to looking at some more of your interviews. Thanks very much. And look, just on Brexit, if you haven't caught up, Theresa May has offered a delay to up to the June the 30th. And we're seeing if Europe is going to agree to that, but only on the basis that her deal gets passed. So goodness knows what's going to happen next week. After the break, back here, rates on hold in the US and local unemployment at an 8-year low. We'll get into all of that with the Wall Street Journal's senior economics reporter, James Glynn.
Now, back to Ticky.
Welcome back. Well, the US Federal Reserve has held interest rates steady. Policymakers abandoning projections for further hikes this year, flagging it expects the economy to cool.
We continue to expect that the American economy will grow at a solid pace in 2019, although likely slower than the very strong pace of 2018. We believe that our current policy stance is appropriate.
Well, in a major shift in its perspective, the Fed expects to raise borrowing costs only once more through to 2021 and no longer anticipates the need to guard against inflation with restrictive monetary policy. Investors, though, were focused solely on the balance, with Chair Jerome Powell saying the central bank would end its runoff in September, provided the economy and money market conditions evolved as expected.
In terms of the size of the balance sheet, the balance sheet will be of a size of approximately 17% of GDP around the end of this year, down from 25% of GDP at the end of 2014. So significantly smaller relative to GDP than it was. I'm guessing you're looking for a dollar number, though, probably, and that would be, so for the size of the balance sheet, it looks like it'll be a bit above $3.5 trillion.
Well, the moves mean after tightening policy with two levers at once over the past year, the Fed is now pausing on both fronts to adjust to weaker global growth. Yeah, and those of you who saw our interview with Neil Ferguson the other day will know the role of Richard Clarida and those sorts of market pressures on the Fed. So it's really interesting time for that shift in strategy, I think. But let's move back to Australia. Australia's unemployment rate has fallen to an 8-year low, dropping to 4.9% in February, with 4,600 jobs created. The strong figures defying fears of stalling activity in the economy amid a so-called per capita recession. Still, economists say some weakness persists, pointing to the participation rate, which fell to 65.6%. Full-time jobs were also down, despite a blockbuster result in January, falling by 7,300. Part-time jobs rose by 11,900, while the rate of young Australians out of work jumped to 11.2%, double the rate of the rest of the population. Well, for more on this, I'm pleased to welcome James Glynn, Senior Economics Reporter at the Wall Street Journal. James, great to have you back. We haven't seen you for ages.
Yeah, sorry about that, Ticky. It's good to be back.
Yeah, I know you've been busy. Now, look, what do you make of this? I mean, it was quite a surprise number, wasn't it?
It was. We get released. There's a group of reporters that get to see the numbers 10 minutes early, and we were all sort of shaking our heads this morning when just ahead of 11:30 on that. It was a stunning number, and you would have almost heard an audible sigh from the RBA up at Martin Place, because the 4.9 reinstates their optimistic narrative, which they've been pushing for a long time now.
Well, I thought even Philip Lowe sort of wobbled a bit there. He did.
He bought himself some wriggle room in case the wheels do fall off.
Yes.
But you were just talking there about the Fed. They're reacting to this global slowdown, which is happening in China, which is also happening in Europe. Brexit's a part of it. I would say that the holy trinity of Australian monetary policy, we're talking Phil Lowe, we're talking Guy Nabeel, we're talking Lucy Ellis at the Central Bank.
The holy trinity.
We'll be gathering today to backslap a little bit, because 4.9 is a stunning number.
Yeah, even though full-time jobs, and for some, isn't it 3 times in a row now full-time jobs have been falling?
No, I think that there was last month we had a big jump in full-time.
Oh, jump. I'm sorry, I got that wrong. Yeah.
So there's no doubt there has been a bit of a slowdown.
Yep.
The forward-looking indicators of the job market, which is the headlights for everybody, we're keeping watch. Yes, there's been a slowdown. It's undeniable that through the last part of 2018, NAB survey falls through the floor. We've got house prices falling. There's a shadow over the housing construction market. That's all going to drag on GDP. We're not going to get the 3% GDP that the RBA was forecasting, but equally, I think we'll soldier through this.
What about the stimulus from the budget?
Well, the stimulus. Let's talk about April 2, and let's talk about Josh Frydenberg, our illustrious treasurer.
Yes.
He's sitting on an iron ore price of $100 per tonne, which is a phenomenal number if you're a treasurer. You can hear the...
So what's that done to his surplus?
Well, you can hear the money dropping into the coffers, right? It's audible, right? And he's got about $5 or $6 billion to spend. He can come out and do that without, and still promise to everybody we're going to have a surplus. So that's a pretty enviable situation for him. For a treasurer that's behind in the polls, 2 months out from an election, the economy needs a short circuit, something to short circuit the gloom, and the budget is a perfect opportunity to do that. Spend a bit.
Yeah, and did I see some RBA work on the fact that if you did do some spending, that would actually impact consumer demand? It might not necessarily help on the mortgage front, but it might help consumer demand.
Well, the question is, if you cut rates from here, you're at 1.5% on the cash rate, and you go to 1, and then you start talking about QE, that'll come very quickly. This question of when does Australia start QE, and to me that the Australian investor, the Australian property owner, is very astute, and they'll start hearing this conversation about the coming of QE, and that might spook the horses, if you ask me.
Yeah. But are we going to see a rate cut? People are saying, oh, there might be a budget rate cut, but that's not likely, is it? A cut on budget day?
Not with an unemployment rate at 4.9 and apparently heading lower. And let's think, New South Wales, the unemployment there is hovering around 4%. So the next question is, where are the wages?
Exactly.
and that's the great mystery here. It's technological change. It's, the Australian labour market's not as unionised as it used to be.
Well, let me put it another way. Why has the traction happened in the US is it just that the way technology works in this country, unemployment has to be even lower for this traction to start?
Well, the RBA worked with a model. Their modelling currently says if we have an unemployment rate below 5%,
yes,
well, that equals wages moving up in a fairly positive way. Wages are moving up. We've still got, what are we, 2.4 or something on year at the moment, which isn't bad considering where we're going. The bottom line for the RBA is that the job market continues to tighten, albeit very slowly.
Yes.
There is some sign of wages growth. It's most of us aren't feeling it yet, but the narrative is playing out, albeit it's a little bit stilted.
And no rate cut for a while yet?
No, I think they'll be very much waiting for this budget to come through to sort of to
see what it does in terms of stimulate
of bloom.
All right, James Glynn, very interesting. We'll keep watching that. Come back and talk to us about it.
Okay.
Terrific. All right, well, that's all for the show tonight. Tomorrow night, Premier Investments Chairman Solomon Lew and Executive Director Mark McInnes. A double whammy on the company's interim results. Thanks for your company.